Welcome back to Investing Talk Podcast. Today we're tackling a question that's likely on many of your minds. Is Oscar Health a good time to buy now? It's quite a fascinating company in a really complex sector. We've gathered all the key information from the latest articles, research reports, and our own notes. Our goal is to give you a clear, concise overview of Oscar Health's current standing, its potential, and of course, the risks involved. We want to cut through the noise, really, and deliver those crucial nuggets of insight directly to you. And hey, before we jump in, if you find this kind of analysis helpful, please consider subscribing, maybe liking this episode, and leave a comment below. Your engagement truly helps us bring you more of these analyses. And if you're feeling generous, you can also support us by buying us a coffee. Also, if there's a specific company you'd like us to look into next, just drop a comment. We'll add it to our list.
Absolutely. And for Oscar Health today, we'll be looking at it from, multiple angles. We'll start with the fundamentals, the core business. Then we'll compare its valuation to its peers. After that, we'll analyze its recent stock movements, look at the latest news and market sentiment, and importantly, pinpoint the crucial risk factors. And then we'll bring all these threads together, give it an overall rating, some thoughts on potential entry points, trying to offer, a holistic picture for your consideration.
All right, sounds good. Let's unpack this then, starting right at the foundation, the fundamentals. How healthy is Oscar Health's core business, especially when we talk about growth? What kind of expansion are we actually seeing?
Well, what's really fascinating here is just the sheer pace of that expansion. Oscar Health reported a striking 42% increase in revenue in just Q1. That's huge. And looking ahead, the projections are, while they're equally ambitious, suggesting annual sales growth of around 12.5% from 2024 to 2027.
Wow, 12.5% annually.
Yeah, this isn't just, general growth. It's really a testament to their aggressive market penetration. It indicates they're rapidly gaining ground in what's a highly competitive, often very entrenched healthcare sector. For a relatively young health tech player, that kind of consistent projected growth over several years, that's a significant signal, especially for investors eyeing that long-term potential.
Okay, that kind of revenue acceleration sounds incredibly promising, especially in healthcare.
Right.
But as we always say, growth isn't everything, is it?
Yeah.
What about profitability? Are they growing sustainably, or is it maybe a case of growth at any cost, which can quickly become a real issue for investors?
That's exactly the critical flip side. While the revenue is undeniably up, profit margins are significantly impacted by what's known as a high medical loss ratio, or MLR.
Right, the MLR.
Exactly. This ratio is expected to be somewhere between 80.7% and 81.7% in 2025. Now, to put that in perspective, a high MLR means a substantial portion, we're talking over 80 cents of every dollar in premium revenue, is going directly toward covering medical claims.
That doesn't leave much else.
It leaves a much smaller slice for operating expenses and, crucially, for profit. It really raises an important question, doesn't it, about how efficiently they're actually managing their core healthcare costs.
So on one hand, you've got this aggressive expansion, but then on the other, a huge chunk of their revenue just gets eaten up immediately by claims. That sounds like a bit of a tightrope walk.
It is.
But, okay, even with high costs, a strong balance sheet can provide that crucial safety net, right? What about their financial stability, their cash position, any significant debt?
You've hit on a really key point there. Despite those high medical costs, the company maintains a remarkably robust balance sheet. They're sitting on approximately $4.9 billion in cash and investments.
$4.9 billion.
Yeah, and that includes a solid $1.5 billion in insurance subsidiary capital and surplus. This substantial cash position isn't just impressive, it's absolutely crucial. It provides a strong foundation for strategic growth initiatives like, further tech development or market expansion. And it acts as a significant buffer against those persistent high medical costs we just talked about.
Okay.
It suggests they have the financial horsepower, really, to navigate challenges and pursue opportunities, even if profitability remains, a work in progress.
That's definitely a powerful position to be in. So strong growth, high but perhaps managed costs, and a significant cash reserve. Looking ahead then, what are the earnings projections? Do analysts see a clear path to consistent profitability, or is there still some murkiness in the forecast?
Well, earnings from operations are indeed projected to be positive. They're expected to land somewhere between $225 million and $275 million in 2025.
Okay, so positive earnings.
Yes, but this is where the picture gets complex. Analyst projections are quite mixed. Some foresee significant upside potential, which is certainly what long-term investors are hoping for.
Naturally.
Yet others express considerable concerns over those rising costs we mentioned and the ongoing pricing pressures that are just inherent to the highly competitive healthcare industry. This divergence in opinion isn't just about different numbers, it sort of speaks to a fundamental debate over Oscar Health's business model. Can a tech-first insurer truly crack the code on healthcare costs, or is it more of a high-growth, high-risk bet that could either revolutionize the industry or potentially struggle under its own weight?
That really highlights the uncertainty, doesn't it?
It does.
In such a competitive landscape, I mean, you've got established giants, nimble startups. Where does Oscar Health stand out? Do they possess any unique advantages, something that might give them an edge and help them actually achieve those more optimistic earnings projections?
This is absolutely key for its long-term viability, and it's where their strategy really comes into play. Oscar Health benefits significantly from operational efficiency, particularly in achieving a low selling, general, and administrative or SG&A expense ratio.
Lower SG&A, right?
That efficiency provides a tangible competitive advantage. Unlike, say, traditional insurers burdened by legacy systems, their inherent focus on technology and automation is designed to support rapid scalability, while at the same time aiming to maintain high service quality. In a sector as complex and cost-intensive as healthcare, any gains in efficiency can be a real differentiator. It allows them to potentially offer more competitive pricing or invest further in the member experience.
Okay, so we've kind of dissected their operations. Rapid growth, that tightrope walk on costs, strong cash, and this tech-driven operational edge.
Yeah.
The natural next question is, how is the market valuing this complex picture? Is the price right? Or are investors maybe getting a bit ahead of themselves given all the variables?
Right, and that's where valuation metrics become crucial. When we look at the forward price to earnings, or PE ratio, which, essentially tells us how much investors are willing to pay for each dollar of future earnings, it stands at a very high 86.75.
86. That does seem high.
It is significantly higher than many of its peers in the healthcare insurance space. It clearly indicates potential overvaluation. And while our sources don't explicitly detail the price to sales, or PS ratio, given such a high PE, it's, highly probable that their PS ratio is also elevated.
So just to clarify, comparing it to industry averages, it sounds like it's trading at a pretty hefty premium.
Mm-hmm.
Like investors are already baking in a lot of future success into the current share price, paying a big price for that growth potential.
Precisely. The firm's valuation metrics are generally higher across the board compared to industry averages. It suggests that it may be richly valued compared to some of its competitors. Now, this doesn't necessarily mean it won't grow into that valuation, but it does mean there's less margin for error. If those ambitious growth projections don't materialize as quickly as anticipated, or if those medical costs prove harder to control, there could be a higher downside risk given the current premium. It certainly demands a very close look at the underlying assumptions.
Okay. So beyond the fundamentals and that potentially rich valuation, for those watching the charts, looking at daily movements, what does the stock's recent price action tell us? This is where the technical picture gets, pretty dynamic, doesn't it?
Oh, absolutely. The stock has been a real roller coaster, experiencing very high volatility with significant, often sudden price swings. For instance, there was that dramatic 52% weekly jump back in June, which caught many off guard.
52% in a week.
Yeah, but then that was followed by recent declines, primarily due to negative analyst coverage and the unsettling news of key executive resignations. This just indicates a very dynamic and, at times, quite unpredictable stock.
Yeah.
It's definitely not for the faint of heart. Those sharp moves can lead to substantial gains or losses very quickly, making risk management absolutely paramount.
Given that kind of wild volatility, what are the key support and resistance levels an investor, maybe particularly a trader, should be watching? Where might it find a floor or perhaps hit a ceiling if these movements continue?
Well, based on its 52-week trading range, potential support levels might be found somewhere around the $11.20 mark.
Okay, $11.20 support.
And on the upside, resistance could potentially be seen closer to $23.79. Technical indicators like the RSI Relative Strengths Index and MACD Moving Average Convergence Divergence.
The trader favorites.
Exactly, which traders use to gauge momentum and the strength of price movements. They might show overbought conditions during those sharp spikes, often indicating a potential for pullbacks. So for technical traders, these levels become really critical decision points for entry and exit.
And beyond the numbers and the charts, stock prices are often heavily influenced by breaking news, by prevailing market sentiment. What's been making headlines for Oscar Health recently that might be shaping investor perception, both, positively and negatively?
A very significant piece of recent news has been the string of key executive resignations.
Right, you mentioned that.
Yes, and those have naturally raised palpable concerns about leadership stability. In any growth-oriented company, consistent and strong leadership is often seen as just a crucial factor for successfully executing strategy. So any changes at the top, especially multiple ones, can create immediate uncertainty in the market. It makes investors question the company's direction.
Yeah, that makes sense. So how are analysts, those professional stock watchers, viewing all of this? Are they still largely bullish, or has the sentiment shifted given these developments?
The sentiment has certainly shifted. We've seen analyst downgrades, notably from reputable firms like Wells Fargo and Barclays, and those have undoubtedly put significant pressure on the stock price. Currently, the collective analyst community, sort of on balance, leans towards a sell rating. However, it's not a unanimous call. Some analysts still express optimism about future potential, even amidst the ongoing concerns over rising costs and industry pricing pressures. This mixed, yet predominantly cautious sentiment from the analyst community is definitely a significant factor contributing to the stock's recent volatility and uncertainty.
Okay, so we've looked at where the company stands now, but what could move the needle in the future? What are the potential catalysts that could send the stock in a new direction? And conversely, what are the crucial risk factors that potential investors absolutely need to be aware of?
Looking ahead, the next earnings report is a big one. It's scheduled for August 6, 2025. The company's performance revealed there could certainly be a significant catalyst there. Stronger than expected results, especially if coupled with clearer guidance on how they plan to manage those persistently high medical costs. That could provide a much-needed boost, potentially shift sentiment. Beyond company specifics, broader developments in Medicare Advantage and overall healthcare reform could dramatically impact Oscar Health's outlook, either positively or negatively, really depending on the regulatory directions taken. The healthcare sector is just heavily influenced by policy shifts, so any legislative changes bear close watching.
And now, on to the crucial flip side for any investment decision, the risks. What specific risks, beyond just general market fluctuations, should potential investors really be aware of when considering Oscar Health?
We can probably categorize these into a few buckets. First, there are the stock-specific risks, like those leadership stability issues following the executive resignations, which, as we said, can create uncertainty about long-term strategy and execution.
Right.
Additionally, the challenge of high medical loss ratios, paired with the potential for further cost increases, remains a persistent concern. If they can't get those costs under better control, it will continue to weigh heavily on their financial performance and their path to consistent profitability.
And zooming out to the broader market, are there bigger industry or economic trends that could pose a threat to Oscar Health's trajectory?
Absolutely. Beyond their individual operations, there are significant sector-specific risks. Regulatory uncertainty in healthcare is a constant overhang. Policy shifts, changes in reimbursement models, new mandates. These could all significantly alter their business environment, impact enrollment and profitability. And then, on a macroeconomic level, widespread economic downturns could directly affect overall healthcare spending and insurance demand. In a recessionary environment, for instance, people might opt for lower-cost plans, or maybe even delay non-essential care. That could impact the entire insurance industry, including Oscar Health.
Okay. So bringing all these facets together, then the promising growth, the challenging costs, the unique tech edge, the volatile stock, the leadership questions, the broader industry landscape, what does this all mean for you, our listener? If we had to distill this into an overall rating for Oscar Health based on these sources, what would it be?
Okay, well, based on the entirety of the source material we've looked at, the rating for Oscar Health comes out as a 6 out of 10.
A 6 out of 10. Okay.
Yeah, it truly presents a mixed opportunity. While it offers strong growth potential, which is certainly attractive to a segment of investors, it also faces significant risks and challenges that any prospective investor needs to be fully aware of and, frankly, comfortable with. It's definitely not a clear-cut buy or sell at this juncture. It's much more of a nuanced consideration.
And for those considering an entry point, maybe looking to capitalize on some of that current volatility, what might be a potentially good price range to consider? Keeping in mind, this stock has seen some dramatic swings.
Sure. Considering the recent declines and the inherent volatility we've discussed, a potential entry price could perhaps be considered in the range of $12 to $14.
$12 to $14.
But, and this is crucial, it's important to reiterate that this is speculative. Any decision absolutely should be adjusted based on your individual risk tolerance and your investment strategy. Market conditions can change very rapidly.
Good point. And is this more of a short-term play, you think, capitalizing on those price swings? Or does its profile suggest it's better suited as a long-term hold, betting on the company's foundational growth and its disruptive potential?
I think this stock appears to be more suitable for long-term investors, primarily due to its underlying growth prospects and the long-term potential of its operational efficiencies. Short-term traders might certainly try to capitalize on the volatility, but that comes with significantly higher risk, just given the unpredictable nature of those swings.
Right.
Long-term investors, conversely, are typically looking past the daily fluctuations. They're focusing instead on the underlying business trajectory and its potential to mature within the healthcare tech space.
And for those more aggressive short-term traders, the ones willing to navigate that higher risk,
Yeah.
what general guidance might you offer on managing that risk, say, with stop loss and take profit targets?
Okay, for traders focused on those shorter term movements, setting a stop loss maybe around 10% below your entry price could be a prudent approach to manage potential downside.
10% stop loss, okay.
And on the upside, a take profit target at a significant resistance level, perhaps in that $18 to $20 range we mentioned earlier, could be considered to lock in gains. But again, these are general guidelines, of course. They should always align with an individual's specific trading plan and their own risk appetite.
OSCR Health certainly offers potential for long-term growth, driven by that operational efficiency and those strong revenue projections we discussed. But it's equally clear that any short-term trading involves navigating some really high volatility and carefully managing risks tied to leadership stability and regulatory uncertainty.
Which brings us to an important question really for you, the listener, to consider as you digest all this information. How will OSCR Health navigate that delicate balance? The balance between rapidly scaling up its technology and subscriber base while continuously managing unpredictable healthcare costs and maintaining a competitive edge in a constantly evolving regulatory landscape. It's a really complex puzzle, isn't it? Lots of moving pieces. And their success ultimately will hinge on solving it.
Carefully consider all these factors before making any investment decisions. Remember, understanding the nuances is absolutely key to being truly well-informed in today's markets. We certainly hope this analysis has given you a clearer, more insightful picture. Until next time.